morning, grade 7s. In EMS this term, we have learnt about businesses. We have done accounting concepts, which are capital, assets and liabilities. Remember that capital is money or assets or both that the business owner has put into the business in order to start it. Assets are the possessions of the business, and liabilities are the debts or what is owed. Then we looked at income and expenses. Income is the money that a business earns, and expenses are the running costs, the money going out of the business. Then we looked at profit and losses. And remember that profit was what was left over in the business after the expenses had been paid. And no business wants to make a loss. They want to make a profit. We're now looking at banking and savings and budgets. Now, every business needs to open a bank account, and it should be in the name of the business, not in the name of the owner, because then there can be confusion or overlap between what belongs to the owner and what belongs to the business. There are different kinds of bank accounts. There is a current account, which is also called a check account. There are saving accounts, and there are different types of saving accounts. There is a notice deposit account where the money that the owner has put into the bank account, he can draw out again once he's given the bank notice. The bank needs notice so that they can pull the money back into the account, ready for the owner to withdraw. There is a fixed deposit account where the money from the business is put into an account that cannot be touched. The owner and the bank manager will decide on a period of time. It could be 2 years or 5 years, but during that time, the business owner cannot withdraw that money. It stays in the account and it grows. It accumulates interest. Then there is a call deposit account, which does earn a bit of interest, not as much as the other ones, but a call account is convenient for the owner because they can withdraw the money whenever they like. Businesses can save when there is money left over after all the costs have been paid by putting their savings into a bank account. All businesses need a budget. Now, a budget is a plan for the future to see how much money is likely to be received and how much money is likely to be paid out, so that the business owner has a good idea of where the business is at and what to expect. Now let's look at financial records. Last term we discussed informal businesses and formal businesses, and we learned that a formal business always keeps financial records. Now, financial records are used to keep track of the business transactions so that the owner can make good financial decisions about the future of the business. A bookkeeper or an accountant usually records all the transactions that the business does, and the transactions are the business deals that take place every day. A transaction is something that happens between two people or two businesses or two parties, and it could be the sale of goods, it could be money coming in from customers, it could be the business buying stationery from a supplier, or the business buying stock, which it will sell in the future. There are many different kinds of transactions, and we are going to look at a business in exercise 5.5 where they ask you to look at the business on page 63 and answer questions about their transactions and their financial records. I would like you to do activity 5.4 and 5.5 in your books. Exercise 5.4 asks you to interpret banking information. You've been given a bank statement, and there are columns for payments, a column for deposits, and a column for the balance. Please look at it carefully, study it. It's a comprehension based on that bank statement. And then 5.5 is a comprehension based on the business above it.